How does TLT ETF perform during different phases of the economic cycle, and what strategies are in place to capitalize on varying market conditions? Welcome to our YouTube video where we dive deep into the intricacies of the iShares 20+ Year Treasury Bond ETF, TLT. TLT is a popular investment vehicle known for its exposure to long-term U.S. Treasury bonds. In this video, we'll explore several key aspects of TLT ETF, from the duration of its underlying bonds to its performance across different economic cycles. Join us as we unravel the mysteries of TLT ETF and uncover strategies for navigating its complexities in today's dynamic market environment. Question 1. What is the duration of the underlying bonds held by TLT ETF, and how does this affect its sensitivity to interest rate changes? In the complex landscape of fixed income investing, understanding the nuances of duration is paramount for investors seeking to make informed decisions. This rings particularly true for those considering the iShares 20+ Year Treasury Bond ETF, TLT, where the duration of underlying bonds plays a crucial role in determining the fund's sensitivity to changes in interest rates. Duration, often regarded as a measure of interest rate risk, quantifies the sensitivity of a bond's price to fluctuations in interest rates. It serves as a key metric for assessing the potential impact of interest rate changes on a bond or bond fund's value. Specifically, duration provides an estimate of the time it takes for the present value of a bond's cash flows, coupon payments and principal repayment, to equal its price. The relationship between duration and interest rates is inverse and nonlinear. Put simply, when interest rates rise, bond prices fall, and vice versa. However, the magnitude of price movement varies based on the bond's duration. 1. Longer duration, higher sensitivity. Bonds with longer durations exhibit greater price volatility in response to interest rate changes. This is because a larger portion of their cash flows is received further into the future, making them more sensitive to fluctuations in present value. 2. Shorter duration, lower sensitivity. Conversely, bonds with shorter durations have lower price volatility since their cash flows are weighted more heavily towards the present, reducing their sensitivity to interest rate movements. Given TLT ETF's focus on long-term U.S. Treasury bonds, investors should be cognizant of the fund's extended duration and its implications. 1. Heightened interest rate sensitivity. TLT ETF's longer duration means it is more susceptible to interest rate changes compared to shorter duration bond funds. As a result, investors should be prepared for potential fluctuations in the fund's value, especially in environments marked by interest rate volatility. 2. Portfolio diversification. Despite the increased interest rate risk, TLT ETF can serve as a valuable diversification tool within a broader investment portfolio. Its negative correlation with equities during periods of market stress can help offset equity market downturns, enhancing overall portfolio resilience. 3. Hedging against economic uncertainty. In times of economic uncertainty or market turbulence, investors often flock to safe haven assets like U.S. Treasury bonds, driving prices higher. TLT ETF's longer duration may amplify these price movements, providing a hedge against market volatility. 4. Yield considerations. While longer duration bonds typically offer higher yields to compensate investors for their increased risk exposure, it's essential to weigh this potential income against the associated interest rate risk. Investors should carefully assess their yield objectives and risk tolerance when considering TLT ETF as an investment option. In the realm of fixed income investing, understanding duration is essential for navigating interest rate risk effectively. For investors considering the iShares 20+ Year Treasury Bond ETF, TLT, recognizing the fund's extended duration and its implications is paramount. By comprehending the relationship between duration and interest rates and evaluating TLT ETF's risk-return profile within the broader context of their investment objectives, investors can make informed decisions to construct resilient and diversified portfolios. Question 2. What is the credit quality of the bonds held by TLT ETF, and how does it mitigate default risk?
Soldates I soldats que es van resignar a anar a la guerra. 5 de juliol Revolució d'Octubre.
In the intricate world of fixed income investing, understanding the credit quality of bonds held within exchange-traded funds, ETFs, is paramount for investors seeking to manage default risk effectively. This holds particularly true for the iShares 20+ Year Treasury Bond ETF, TLT, where the creditworthiness of underlying bonds plays a crucial role in determining the fund's risk profile and potential returns. Credit quality refers to the assessment of the issuer's ability to meet its debt obligations in a timely manner. It is typically evaluated by credit rating agencies such as Standard & Poor's, S&P, Moody's Investors Service, and Fitch Ratings, which assign ratings to bonds based on various factors including the issuer's financial strength, repayment history, and economic conditions. For TLT ETF, which primarily invests in U.S. Treasury bonds with maturities exceeding 20 years, the credit quality metric holds significant importance. As of insert date, the fund's holdings consist exclusively of U.S. Treasury securities, which are backed by the full faith and credit of the U.S. government. U.S. Treasury bonds are widely regarded as the gold standard of fixed income investments due to the unparalleled creditworthiness of the U.S. government. As the world's largest and most stable economy, the United States has a long-standing history of honoring its debt obligations, backed by its ability to levy taxes, print currency, and access financial markets. This sovereign advantage translates into U.S. Treasury bonds, boasting the highest credit quality among all fixed-income securities. They are considered virtually risk-free from a default perspective, with negligible probabilities of the U.S. government defaulting on its debt obligations. The pristine credit quality of U.S. Treasury bonds held by TLT ETF serves as a powerful mechanism for mitigating default risk. By investing exclusively in securities issued by the U.S. government, the fund effectively eliminates issuer-specific default risk, providing investors with a high level of confidence in the safety and stability of their investments. The focus on U.S. Treasury bonds within TLT ETF carries several implications for investors. 1. Preservation of capital. The ultra-safe nature of U.S. Treasury bonds ensures that investors' principal amounts are well protected against default risk. This makes TLT ETF an attractive option for investors prioritizing capital preservation over higher yields or riskier assets. 2. Flight to quality. During periods of economic uncertainty or market turmoil, investors often flock to safe haven assets like U.S. Treasury bonds, driving prices higher. TLT ETF's exposure to these high-quality bonds positions it favorably to benefit from such flight-to-quality dynamics. 3. Interest rate sensitivity. While TLT ETF's credit quality eliminates default risk, investors should remain mindful of its sensitivity to changes in interest rates. Like all fixed-income investments, U.S. Treasury bonds are subject to price fluctuations in response to shifts in interest rates, albeit to a lesser extent compared to bonds with lower credit quality. 4. Income generation. Despite their low default risk, U.S. Treasury bonds typically offer lower yields compared to bonds with lower credit quality. Investors considering TLT ETF should weigh the trade-off between safety and income generation, aligning their investment objectives with their risk tolerance and income needs. In the realm of fixed-income investing, credit quality serves as a cornerstone for assessing default risk and preserving capital. For investors considering the iShares 20+ Year Treasury Bond ETF, TLT, the exclusive focus on U.S. Treasury bonds provides a robust shield against issuer-specific default risk, bolstering confidence in the safety and stability of their investments. By understanding the implications of TLT ETF's credit quality within the broader context of their investment objectives and risk tolerance, investors can make informed decisions to construct resilient and well-balanced portfolios. Question 3. What are the implications of an inverted yield curve on TLT ETF's performance and investment strategy? In the intricate world of fixed income investing, few phenomena command as much attention and speculation as the yield curve. An inverted yield curve, where short-term interest rates exceed long-term rates, often sends ripples across financial markets, triggering concerns about economic recession and reshaping investment strategies. For investors in the iShares 20+ Year Treasury Bond ETF, TLT, understanding the implications of an inverted yield curve is crucial for navigating potential challenges and opportunities. Before delving into its implications, it's essential to grasp the mechanics of an inverted yield curve. Traditionally, the yield curve slopes upwards, with longer-term bonds offering higher yields than shorter-term bonds. This reflects the compensation investors demand for locking up their capital for extended periods. Conversely, an inverted yield curve occurs when short-term interest rates surpass long-term rates. This inversion typically signals market expectations of economic slowdown or recession, as investors seek the safety of longer-term bonds amid uncertainty about future economic conditions. As a vehicle primarily invested in long-term U.S. Treasury bonds, TLT ETF's performance and investment strategy can be significantly impacted by an inverted yield curve. Here are some key implications for investors to consider. 1. Price appreciation. An inverted yield curve often triggers a flight to quality, with investors flocking to safe haven assets like U.S. Treasury bonds. This increased demand can drive up bond prices, leading to capital appreciation for TLT ETF investors. 2. Yield compression. While bond prices may rise in response to an inverted yield curve, yields typically decline as investors accept lower returns on longer-term bonds. This phenomenon, known as yield compression, can dampen TLT ETF's income generation potential, especially for investors relying on bond yields for income. 3. Duration sensitivity. TLT ETF's extended duration makes it particularly sensitive to changes in interest rates, including those driven by an inverted yield curve. Investors should be prepared for potential fluctuations in the fund's value as interest rate dynamics evolve in response to economic conditions. 4. Portfolio rebalancing. In response to an inverted yield curve, TLT ETF's portfolio managers may adjust the fund's composition to optimize risk-return profiles. This could involve rebalancing allocations between different maturities or sectors within the Treasury bond market to capitalize on changing market dynamics. 5. Macroeconomic considerations. Beyond its direct impact on bond prices and yields, an inverted yield curve may signal broader macroeconomic shifts that can influence TLT ETF's performance. Investors should monitor economic indicators and central bank policies to gauge the potential implications for the fund. Given the potential impact of an inverted yield curve on TLT ETF's performance, investors may consider adopting the following strategies. 1. Diversification. Maintaining a diversified portfolio can help mitigate risks associated with interest rate fluctuations and economic uncertainty. Combining TLT ETF with other asset classes, such as equities, real estate, or alternative investments, can provide additional sources of return and risk diversification. 2. Active management. In periods of heightened market volatility and economic uncertainty, active management can play a crucial role in navigating changing market conditions. Investors may consider actively managed bond funds or professional asset managers with expertise in fixed income markets to capitalize on opportunities and manage risks effectively. 3. Risk mitigation. Given TLT ETF's sensitivity to interest rate movements, investors should assess their risk tolerance and implement strategies to mitigate potential downside risks. This may involve incorporating hedging techniques, such as options or futures contracts, to protect against adverse market movements. 4. Income generation. While an inverted yield curve may compress bond yields, investors can explore alternative income-generating strategies to supplement TLT ETF's distributions. This could include dividend-paying stocks, high-yield bonds, or income-focused ETFs to enhance portfolio income in a low-yield environment. 5. Long-term perspective. Despite short-term market fluctuations, investors should maintain a long-term perspective when investing in TLT ETF. U.S. Treasury bonds have historically served as a reliable source of income and capital preservation, making them valuable components of a well-diversified investment portfolio over the long term. In summary, an inverted yield curve can have significant implications for TLT ETF's performance and investment strategy. While it may present challenges such as yield compression and duration sensitivity, it also offers opportunities for capital appreciation and risk management. By understanding the dynamics of an inverted yield curve and adopting appropriate investment strategies, investors can navigate market uncertainty effectively and position their portfolios for long-term success with TLT ETF. Question 4. What are the macroeconomic factors that could influence the performance of TLT ETF in the near and long term? In the ever-evolving landscape of fixed income investing, the performance of exchange-traded funds (ETFs), such as the iShares 20+ Year Treasury Bond ETF, TLT, is intricately intertwined with a myriad of macroeconomic factors. From interest rates and inflation to economic growth and geopolitical tensions, understanding the key drivers shaping TLT ETF's performance in the near and long term is essential for investors seeking to make informed decisions. In this comprehensive guide, we delve into the macroeconomic factors that could influence TLT ETF's performance, providing insights and strategies to navigate changing market dynamics effectively. Interest rates and monetary policy. Interest rates, controlled by central banks through monetary policy, are among the most influential factors affecting TLT ETF performance. Here's how. 1. Federal Reserve policy. Changes in the Federal Reserve's monetary policy, including adjustments to the federal funds rate and bond buying programs, quantitative easing, can have a profound impact on TLT ETF. Higher interest rates tend to depress bond prices, leading to potential capital losses for TLT ETF investors. 2. Yield curve dynamics. The shape of the yield curve, which reflects the relationship between short-term and long-term interest rates, can signal market expectations for future economic conditions. Inverted or steepening yield curves may impact TLT ETF differently, depending on investors' perceptions of economic prospects and interest rate trends. Economic growth and inflation. Economic indicators such as GDP growth, inflation rates, and employment figures play a crucial role in shaping TLT ETF performance. 1. Growth expectations. Stronger economic growth can lead to higher inflation expectations and upward pressure on interest rates, potentially dampening TLT ETF returns. Conversely, sluggish economic growth or recessionary conditions may prompt investors to seek the safety of Treasury bonds, bolstering TLT ETF prices. 2. Inflation outlook. Inflation erodes the purchasing power of fixed-income investments like bonds, affecting their real returns. TLT ETF investors closely monitor inflation trends and central bank responses to gauge the potential impact on bond yields and prices. Geopolitical risks and market sentiment. Geopolitical tensions, global events, and market sentiment can influence investor behavior and TLT ETF performance. 1. Risk aversion. Heightened geopolitical tensions or market uncertainty often trigger a flight to safety, driving demand for U.S. Treasury bonds and boosting TLT ETF prices. Conversely, improved market sentiment or risk-on sentiment may lead investors to favor riskier assets over bonds, exerting downward pressure on TLT ETF. 2. Market volatility. Increased volatility in financial markets can impact TLT ETF performance, as investors reassess risk exposures and asset allocation strategies. TLT ETF status as a safe haven asset may attract inflows during periods of market turbulence, supporting bond prices. Federal budget and fiscal policy. Government fiscal policy, including tax changes, spending programs, and budget deficits, can influence TLT ETF performance. 1. Supply and demand dynamics. Government borrowing to finance budget deficits increases the supply of Treasury securities, potentially exerting upward pressure on bond yields and downward pressure on prices. TLT ETF investors monitor fiscal policy developments to assess the implications for bond market dynamics. 2. Debt sustainability. Rising government debt levels and concerns about debt sustainability may affect investor confidence in Treasury bonds and TLT ETF. Long-term fiscal sustainability issues could lead to higher borrowing costs for the government, impacting TLT ETF returns. Global economic trends and currency markets. Global economic trends and currency movements can impact TLT ETF performance through various channels. 1. Global growth outlook. TLT ETF investors consider global economic trends and their implications for U.S. Treasury bonds. Economic slowdowns or recessions in major economies may increase demand for safe haven assets like TLT ETF, supporting bond prices. 2. Currency fluctuations. Currency movements, particularly changes in the value of the US dollar relative to other currencies, can affect TLT ETF returns for international investors. Currency appreciation or depreciation may influence foreign investors' demand for U.S. Treasury bonds and TLT ETF. Environmental, social, and governance (ESG) factors. Increasingly, environmental, social, and governance (ESG) considerations are shaping investment decisions, including those related to TLT ETF. 1. ESG integration. TLT ETF investors may consider ESG factors such as climate change risks, social responsibility, and corporate governance practices when evaluating bond issuers and their impact on TLT ETF performance. 2. ESG investing trends. Growing investor demand for ESG-aligned investments may influence TLT ETF performance indirectly through changes in market sentiment, issuer behavior, and capital flows. Strategies for navigating macroeconomic factors. Given the diverse array of macroeconomic factors influencing TLT ETF performance, investors may adopt several strategies to navigate changing market conditions. 1. Diversification. Maintaining a diversified portfolio across asset classes, sectors, and geographic regions can help mitigate risks associated with macroeconomic fluctuations and enhance portfolio resilience. 2. Active management. Active management strategies may be employed to capitalize on market inefficiencies, adjust portfolio exposures dynamically, and navigate shifting macroeconomic trends effectively. 3. Risk management. Implementing risk management techniques such as hedging, portfolio rebalancing, and scenario analysis can help mitigate downside risks associated with macroeconomic volatility and uncertainty. 4. Long-term perspective. Maintaining a long-term investment horizon and focusing on fundamentals can help investors weather short-term market fluctuations driven by macroeconomic factors while capturing potential returns over the investment horizon. In conclusion, macroeconomic factors exert a significant influence on TLT ETF performance, shaping investor sentiment, bond market dynamics, and portfolio returns. By understanding the interplay between interest rates, economic growth, inflation, geopolitical risks, fiscal policy, global trends, and ESG considerations, investors can make informed decisions to navigate changing market conditions effectively and achieve their investment objectives with TLT ETF. As with any investment, it's crucial to conduct thorough research, assess risk exposures, and seek professional advice when necessary to construct a well-diversified and resilient portfolio aligned with individual financial goals and risk tolerance levels. Question 5. How does TLT ETF fit within a diversified investment portfolio, particularly in relation to equities and other fixed-income assets? Diversification is a fundamental principle of investment management, aimed at reducing portfolio risk by spreading investments across different asset classes with low correlations. By diversifying, investors can potentially enhance returns while mitigating downside risk, as losses in one asset class may be offset by gains in another. Equities versus fixed-income assets. Equities and fixed-income assets represent two primary asset classes within a diversified portfolio, each offering distinct risk-return profiles. 1. Equities. Equities, or stocks, represent ownership stakes in publicly traded companies. They offer the potential for capital appreciation and dividends, but come with higher volatility and greater downside risk, especially during market downturns. 2. Fixed-income assets. Fixed-income assets, including bonds and bond funds like TLT ETF, provide regular interest income and capital preservation. They offer lower volatility and serve as a hedge against equity market downturns, making them valuable for portfolio diversification. Strategic allocation of TLT ETF. TLT ETF, with its focus on long-term U.S. Treasury bonds, offers several benefits within a diversified investment portfolio. 1. Risk mitigation. TLT ETF's negative correlation with equities during periods of market stress makes it an effective diversification tool. When stock prices decline, investors often seek the safety of Treasury bonds, driving up prices and offsetting losses in equities. 2. Capital preservation. U.S. Treasury bonds are considered among the safest fixed-income investments, backed by the full faith and credit of the U.S. government. TLT ETF provides exposure to these high-quality bonds, offering investors a reliable source of capital preservation in times of market uncertainty. 3. Income generation. TLT ETF generates regular interest income through its holdings of Treasury bonds, making it suitable for income-focused investors. The steady cash flows from bond coupon payments can complement dividend income from equities, enhancing overall portfolio yield. 4. Duration diversification. TLT ETF's longer duration compared to shorter-term bond funds provides additional diversification benefits. Its sensitivity to interest rate changes may differ from other fixed-income assets, offering investors a hedge against unexpected shifts in monetary policy. Portfolio construction strategies. Incorporating TLT ETF into a diversified investment portfolio requires careful consideration of asset allocation and rebalancing strategies. 1. Asset allocation. The allocation to TLT ETF within a portfolio should be based on investors' risk tolerance, investment objectives, and time horizon. A common approach is to allocate a portion of the portfolio to fixed-income assets, with TLT ETF serving as a core holding within this allocation. 2. Rebalancing. regular portfolio rebalancing ensures that the allocation to TLT ETF remains consistent with the desired asset mix. Rebalancing involves selling assets that have outperformed and buying assets that have underperformed to maintain the target allocation and manage risk effectively. 3. Tactical adjustments. In response to changing market conditions, investors may make tactical adjustments to their allocation to TLT ETF. For example, increasing exposure during periods of heightened market volatility or economic uncertainty can provide additional downside protection, while reducing exposure during periods of strong economic growth may enhance portfolio returns. TLT ETF plays a valuable role within a diversified investment portfolio, offering exposure to long-term U.S. Treasury bonds and providing benefits such as risk mitigation, capital preservation, income generation, and duration diversification. By strategically allocating TLT ETF alongside equities and other fixed income assets, investors can construct well-balanced portfolios that optimize risk-adjusted returns and withstand market volatility. However, it's essential to regularly monitor and review portfolio allocations, make tactical adjustments as needed, and stay informed about market developments to ensure that the portfolio remains aligned with investment objectives and risk tolerance levels. With thoughtful portfolio construction and diligent monitoring, investors can harness the diversification benefits of TLT ETF to achieve long-term financial success. Question 6. What is the strategy for managing TLT ETF's duration risk, especially during periods of significant interest rate fluctuations? Duration measures the sensitivity of a bond's price to changes in interest rates. It provides investors with insight into how much a bond's price is expected to change for a given change in interest rates. For TLT ETF, which invests in long-term U.S. Treasury bonds, duration risk is a critical consideration due to the fund's exposure to interest rate movements. Managing duration risk in TLT ETF requires a proactive and disciplined approach, incorporating various strategies to mitigate downside risk and capitalize on market opportunities. Here are several key strategies for effectively managing duration risk in TLT ETF. 1. Active duration management. TLT ETF's portfolio managers actively monitor interest rate trends and adjust the fund's duration exposure accordingly. By dynamically managing the portfolio's duration, they seek to optimize risk-adjusted returns in different market environments. During periods of significant interest rate fluctuations, such as tightening or easing cycles by central banks, TLT ETF's managers may adjust the fund's duration through rebalancing or reallocation strategies to position it strategically in anticipation of future rate movements. 2. Sector rotation. TLT ETF may adjust its allocation across different sectors of the Treasury bond market to manage duration risk effectively. For example, shifting exposure between long-term and intermediate-term bonds can help fine-tune the fund's overall duration profile. During periods of rising interest rates, TLT ETF's managers may reduce exposure to longer duration bonds and increase allocations to shorter duration bonds to minimize interest rate sensitivity and potential price declines. 3. Derivative instruments. TLT ETF may utilize derivative instruments such as interest rate swaps or options to hedge against changes in interest rates or adjust its duration exposure more efficiently. By incorporating derivatives into its investment strategy, TLT ETF can manage duration risk while maintaining flexibility and liquidity in its portfolio. Derivatives allow TLT ETF to implement tactical adjustments to its duration exposure in response to evolving market conditions, providing downside protection and enhancing risk-adjusted returns. 4. Scenario analysis and stress testing. TLT ETF's managers conduct scenario analysis and stress testing to assess the potential impact of different interest rate scenarios on the fund's performance. By simulating various interest rate environments and analyzing their effects on TLT ETF's portfolio, managers can identify vulnerabilities and implement risk management measures to mitigate adverse outcomes. Scenario analysis helps TLT ETF's managers anticipate potential risks and opportunities, allowing them to adjust the fund's duration exposure proactively and optimize portfolio positioning. 5. Communications and transparency. TLT ETF's managers maintain open communication with investors regarding the fund's duration risk management strategies and objectives. Transparency in disclosing the fund's duration exposure, interest rate sensitivity, and risk management practices enhances investor confidence and trust. By providing regular updates and insights into TLT ETF's duration risk management approach, managers ensure that investors are informed and empowered to make well-informed investment decisions. Managing duration risk in TLT ETF requires a comprehensive and disciplined approach, incorporating active duration management, sector rotation, derivative instruments, scenario analysis, and transparent communications. By implementing these strategies, TLT ETF's managers aim to optimize risk-adjusted returns and mitigate downside risk during periods of significant interest rate fluctuations. Investors in TLT ETF can benefit from the fund's proactive duration risk management approach, which seeks to enhance portfolio resilience and capitalize on market opportunities. As with any investment strategy, it's essential for investors to conduct thorough research, assess risk exposures, and align their investment decisions with their financial goals and risk tolerance levels. With a clear understanding of TLT ETF's duration risk management strategies and objectives, investors can navigate the complexities of fixed income investing effectively and position their portfolios for long-term success. Question 7. How does TLT ETF perform during different phases of the economic cycle, and what strategies are in place to capitalize on varying market conditions? The economic cycle consists of 4 distinct phases: expansion, peak, contraction, and trough. Each phase presents unique challenges and opportunities for investors, and TLT ETF's performance can vary accordingly. 1. Expansion phase. During periods of economic expansion, characterized by robust GDP growth, low unemployment, and rising consumer confidence, TLT ETF may underperform relative to riskier assets such as equities. Investors may favor growth-oriented investments over safe haven assets like Treasury bonds, leading to lower demand for TLT ETF and potential price declines. 2. Peak phase. As the economy approaches its peak, inflationary pressures may mount, prompting central banks to tighten monetary policy by raising interest rates. TLT ETF's performance during this phase depends on the pace and magnitude of interest rate hikes. If rate increases are gradual and well telegraphed, TLT ETF may experience modest price declines as yields rise. However, if rate hikes are rapid or unexpected, TLT ETF could face more significant headwinds as bond prices fall. 3. Contraction phase. During economic contractions or recessions, TLT ETF typically outperforms riskier assets as investors seek the safety of Treasury bonds amid market turmoil. Flight to quality dynamics drive up demand for TLT ETF, leading to price appreciation and lower yields. The fund's defensive characteristics make it an attractive option for investors looking to preserve capital and hedge against equity market downturns. 4. Trough phase. As the economy reaches its trough and begins to recover, TLT ETF's performance may start to moderate as investors rotate back into risk assets. However, the fund may continue to provide stability and income generation during the early stages of the recovery, serving as a core component of diversified portfolios. TLT ETF employs several strategies to capitalize on varying market conditions across different phases of the economic cycle. 1. Dynamic asset allocation. TLT ETF's portfolio managers adjust the fund's asset allocation dynamically in response to changing market conditions and economic indicators. During periods of economic expansion, the fund may reduce exposure to longer duration bonds and increase allocations to shorter duration bonds to mitigate interest rate risk. Conversely, during economic contractions, TLT ETF may overweight longer duration bonds to maximize capital appreciation and income generation. 2. Sector rotation. TLT ETF may rotate its exposure across different sectors of the Treasury bond market to capitalize on relative value opportunities. For example, the fund may overweight or underweight allocations to specific maturities or yield curves based on interest rate expectations and yield curve dynamics. Sector rotation allows TLT ETF to fine-tune its duration exposure and optimize risk-adjusted returns across different economic environments. 3. Tactical hedging. TLT ETF may employ tactical hedging strategies, such as interest rate swaps or options, to hedge against adverse market movements or exploit mispricings in the bond market. Derivative instruments provide TLT ETF with flexibility and liquidity to implement tactical adjustments to its portfolio positioning and manage duration risk effectively. 4. Active management. TLT ETF's active management approach allows its portfolio managers to leverage proprietary research, quantitative models, and fundamental analysis to identify investment opportunities and mitigate risks. Active management enables TLT ETF to navigate changing market conditions, exploit market inefficiencies, and generate alpha for investors over the long term. TLT ETF's performance varies across different phases of the economic cycle, reflecting shifts in interest rates, inflation expectations, and market sentiment. By employing dynamic asset allocation, sector rotation, tactical hedging, and active management strategies, TLT ETF aims to capitalize on varying market conditions and deliver competitive risk-adjusted returns for investors. As with any investment strategy, it's essential for investors to conduct thorough research, monitor economic indicators, and stay informed about market developments to make well-informed investment decisions. With TLT ETF's adaptive approach to navigating economic cycles, investors can position their portfolios strategically to achieve their financial goals and withstand market volatility effectively. As we conclude our exploration of TLT ETF, it's evident that this investment vehicle offers unique opportunities and challenges for investors. From understanding the duration of its underlying bonds to managing its performance across economic cycles, TLT ETF requires careful consideration and strategic planning. By incorporating TLT ETF into a well-diversified investment portfolio and implementing effective risk management strategies, investors can harness its potential to achieve their financial goals and navigate today's ever-changing market landscape with confidence. Thank you for joining us on this journey, and we look forward to seeing you in our next video. Don't forget to like, share, and subscribe for more insights into the world of finance and investing.